Welcome to Facts Not Forecast, your daily edge in the stock market, facts, insights, and opportunities you won't hear anywhere else. Today we're diving into SoFi Technologies, SOFI, one of the most talked about fintech disruptors on Wall Street. Is it really a hidden giant in digital banking, or just another overhyped growth stock? By the end, you'll know whether SoFi is a buy, sell, or hold for your portfolio.
Yeah, SOFI is definitely one you need to understand right now. The buzz around it is just huge.
It really is. And a lot of that buzz, it comes down to the stock's performance, doesn't it? It's been pretty incredible.
Incredible is, well, one word for it. The performance has been so strong, it's almost impossible to ignore. And for investors, the big question is, okay, it's gone up a lot, but can the actual business fundamentals keep up with all this excitement?
Let's put some numbers on that excitement.
Yeah.
So right now, the stock's trading around $27.98.
Roughly, yeah.
But look back over the last year. The 52-week range tells a wild story. It went from a low of, what, $7.57?
$7.57, yeah.
All the way up to a high of $30.30 recently. I mean, it's a massive, massive move.
It really is an explosive move. If you happen to get in at the start of this year, you're looking at a year-to-date return of over 81%.
81%.
And the one-year picture is even more dramatic, up over 257%.
257%.
Exactly. So that's why you suddenly saw all those articles, calling SoFi a potential millionaire maker stock. It was just blasting through resistance levels, hitting new highs.
But it wasn't a smooth ride-up, was it? These weren't small, steady gains. We saw huge monthly jumps.
That's a key point. Massive volatility. Remember November 2024? That month alone, it was up over 46%.
46% in 1 month.
And then again this past summer, right? July 2025, up 24%. June was even bigger, nearly 37%.
So these huge spikes, it suggests a lot of momentum, maybe retail interest driving things?
Absolutely. It's not just slow, quiet accumulation by institutions. There's clearly significant momentum, possibly retail trader excitement fueling those sharp upward moves. The market just seems to love this name right now.
Which makes you step back and ask, okay, is this just hype? Is it trading dynamics?
Yeah.
Or is something fundamentally changing with the company itself that warrants this kind of, well, energy?
That's the core question. We need to separate the signal from the noise. And to do that, you have to look at what SoFi actually does today.
Because it's changed quite a bit from its origins, hasn't it?
It really has. The key thing to grasp is the pivot they made. They started out, over a decade ago, focusing heavily on student loan refinancing. That was their niche.
Right. A very specific lending business.
Exactly. But today, their mission is much broader. They want to be a one-stop shop, a digital-first financial super app.
Okay, so let's unpack that super app strategy, because they seem to have these distinct parts to the business, these pillars.
3 main pillars, yeah. And how they fit together is what makes SoFi interesting, maybe different from other fintechs. First, you've still got the original core, lending.
Still important then.
Oh yeah, it's still a major engine. This includes personal loans, which have actually been a huge growth area for them lately, home loans, and yes, still student loan refinancing.
And that student loan piece.
Yeah.
That could be interesting again, right? If the payment pause finally ends.
Potentially a massive tailwind. If those payments restart, their original core business could see a big resurgence. It builds the initial member relationship, brings people into the ecosystem.
Okay, so lending is pillar one. What's the second? This is the tech piece, right?
Right. Pillar 2 is the technology platform. This is where they really lean into the tech company identity. It's their B2B side. They sell financial infrastructure to other companies, mainly through Galileo and Technisys, which they acquired.
Ah, Galileo Technisys. So they're not just competing with other fintechs, they're selling them tools.
Precisely. Galileo handles things like card processing, payments, essential stuff for other fintechs. Technisys provides a modern core banking platform that other banks or financial institutions can license. It's like they're selling the digital plumbing.
That's fascinating. So it provides a different kind of revenue stream. More stable, maybe?
That's the idea. It acts as a hedge against the ups and downs of the lending market. It's potentially higher margin, more scalable, like software as a service revenue. This is a big part of the argument for why SoFi might deserve a tech valuation, not just a bank valuation.
Selling the picks and shovels, so to speak.
Okay.
That makes sense. And the third pillar,
Pillar 3 is financial services. This is all about getting more value from each customer they bring in through lending or other channels. It's the retail side, the diversification.
So this is things like SoFi Money, their checking and savings.
Yep. SoFi Money, SoFi Invest for trading and robo-advising, the SoFi credit card, SoFi Relay for budgeting, SoFi Protect for insurance. Basically rounding out the financial toolkit for their members.
The whole model seems built around getting a member in, maybe with a loan,
Yeah.
and then selling them more and more services, cross-selling.
Exactly. Create that sticky relationship. And the member growth numbers suggest it's working, at least in terms of attracting people.
What are those numbers?
As of Q2 2025, they reported reaching 11.7 million total members. That's a big number. It shows they're successfully getting people in the door.
11.7 million members. Okay. And that successful growth strategy, that leads us to the financials, doesn't it? Specifically, the profitability aspect.
Yes, the financials are where this story gets really compelling for the bulls, especially that shift to profitability.
That felt like a major turning point in the narrative around SoFi, moving from just growth to actual, bottom line profits.
It absolutely was. Let's look at revenue first, though. The scale-up is impressive. TTM revenue, that's trailing 12 months, hit $4.164 billion as of the second quarter of 2025.
4.1 billion. And that's growing.
Yeah, up 22.6% year over year. And they've been consistently beating analyst expectations, too. Like in Q2 25, revenue was $855 million, way above the $804 million forecast.
And historically, the growth has been even faster at times.
Yeah. Looking back, 2023 saw a revenue jump something like 65% from 2022, just massive growth.
There's also a stat about efficiency. Revenue per employee.
Right, that stood out. Around $753,000 per employee. It suggests their digital-first, maybe lower overhead model is paying off in terms of productivity.
Okay, strong revenue growth, beating expectations, efficiency. But the real headline grabber was profitability, specifically GAAP profitability.
That's the magic word, GAAP, generally accepted accounting principles. For years, tech companies kind of hid behind adjusted numbers, adjusted EBITDA. So SoFi made a point of saying they'd hit real GAAP net income.
And they did it. When was that?
They first hit it in Q4 of 2023, reporting $48 million in GAAP net income, and crucially, they kept it going.
They sustained it.
Yes. Q2 of 2025, they reported $97.26 million in net income. So you've got a string of profitable quarters now.
And that gives them a positive TPM EPS.
Exactly. TTM EPS is 040 cents. Having sustained GAAP profits and a positive EPS, that's like the golden ticket for a company like this. It suggests the model works, it's sustainable, it lifts them out of that purely speculative category.
And what about the overall financial health? Balance sheet.
Looks pretty solid based on the reports. Decent liquidity ratios, which is obviously critical when you're running a lending business, suggest they're capitalized well enough to handle their loan book and keep expanding.
Okay, so let's recap the bull case here. Phenomenal growth, a diversified super app model with that interesting tech platform piece, and now sustained GAAP profitability. It's almost perfect.
It does sound very strong on paper.
Which inevitably leads to the question, what's the catch? Why isn't everyone just piling in? This takes us to the investment dilemma. Because it seems the market has already priced in, well, maybe more than perfection.
That is precisely the tension. The biggest red flag waving over SoFi right now isn't really the business itself, it's the valuation, the price tag.
Okay, how high are we talking? Let's look at the ratios.
We'll start with the classic price-to-earnings ratio, PE. SoFi is trading at roughly 56 times earnings.
56. And the market average S&P 500 is around 30.
Around 30, 31, yeah. So significantly higher. But maybe even more telling is the price-to-sales ratio.
Okay.
Depending on how you calculate it and recent fluctuations, it's been bouncing around 8 to 11 times sales.
8 to 11 times sales. And the industry average for consumer finance
is about 1.7 times sales.
Wow, okay. So SoFi is trading at maybe 5-6 times the price to sales multiple of its industry peers?
Correct. That is an enormous premium. It tells you the market isn't just expecting continued growth, it's expecting absolute dominance. It's pricing in years, maybe a decade, of flawless execution and massive market share gains, especially from that tech platform.
So there's basically no room for error baked into that price.
Very little, if any. If growth slows down, maybe it goes from, say, 60% down to 30%, which is still great growth, that valuation multiple could compress very, very quickly. Any stumble, any missed quarter could hit the stock hard.
Which probably explains why the analysts on Wall Street seem so divided, even with the good financial results.
Exactly. The analyst community is really conflicted here.
What's the overall consensus?
If you average out the ratings from, I think it's 24 analysts covering it, the consensus is just
Neutral.
neutral. Not a
Yeah.
bit, despite the growth in profit.
Neutral. And here's the real kicker. Look at the average 12-month price target from those analysts. It's 21 points on 28 cents.
$21. But the stock is trading near $28 now.
Right, so the average analyst target implies a potential downside of almost 24% from the current price.
A nearly 24% downside predicted by the average analyst. That's stark.
It really highlights the valuation concern. And look at the range of those targets. It goes from a high of 31 price, which is above the current price, sure, but down to a low of just $6. $6? That's an incredibly wide range. It just shows how uncertain the experts are about where this thing is heading.
Huge divergence of opinion. And if you need one more, let's say, potential warning sign, you look at what the insiders are doing, the people who know the company best.
Insider activity. What are we seeing there?
The sources point to a pretty clear pattern of significant insider selling throughout 2025.
Selling from who?
Key executives, the CEO, the CTO, various EVPs, multiple top people have filed to sell or have actually sold large blocks of stock.
And this was happening when the price was high.
Consistently, yes. A lot of these sales were happening when the stock was up in that $26, $27 range.
What's the overall volume look like, sales versus purchases?
Over the last 12 months, the difference is pretty dramatic. Insiders sold about 34.9 million shares.
Okay.
They only purchased about 6.4 million, so sales are vastly outweighing buys.
That doesn't exactly scream confidence from the inside, does it, when executives are selling heavily at these prices?
It certainly raises a flag. You could interpret it as management thinking the stock price might have gotten a bit ahead of itself. They're locking in gains. It makes you question if their internal forecast quite matches the extreme optimism embedded in the stock price.
Okay, so valuation is stretched, analysts are neutral with downside targets, and insiders are selling. Are there other risks mentioned?
Yes, a few others analysts consistently bring up. Regulatory uncertainty is a big one for any fintech, especially one involved in lending and banking. Rule changes could impact them significantly.
Makes sense.
There's also the ongoing concern about equity compensation and dilution. Tech companies often issue a lot of stock to attract and keep talent that dilutes existing shareholders over time.
Right, more shares outstanding means each existing share represents a smaller piece of the pie.
Exactly. And finally, don't forget short interest. It's sitting at 9.27% of the float, which is over 107 million shares. That's a significant number of investors betting against the stock price staying this high.
Okay, so let's try to tie this all together. On one hand, you have this fintech disruptor story. SoFi executed well, got profitable on a GAAP basis, built this diversified model with a potentially high-margin tech platform, and saw explosive member growth. That's the bull case.
A very compelling bull case based on business execution, absolutely.
But on the other hand, you have a valuation that looks, well, sky high compared to peers, demanding near-perfect future growth. You have cautious analysts predicting downside, and you have insiders actively selling shares at these levels.
That's the conflict. Excellent recent performance and strategy versus a price that seems to already reflect immense future success, coupled with some cautionary signals from analysts and insiders. The market seems to believe SoFi isn't just another bank, but maybe the operating system for future finance.
So for you, the listener, what does this boil down to? The facts show a company firing on many cylinders. But the current stock price requires a strong belief that this dominance will continue uninterrupted for a long time. The risk seems elevated purely because of the valuation.
Right. The reward could be huge if they truly become that central fintech platform, but the potential downside is also significant if growth falters or the market decides that premium isn't justified anymore. Can that technology platform scale fast enough to grow into this valuation? Or does the insider selling suggest the rally might be getting tired?
Do you see SFI becoming the next fintech giant, or too risky to bet on? Let us know in comments. Appreciate you tuning in. Until next time, stay sharp, stay patient, and let the market work for you.